Hey Harvesters, and welcome to the channel. My name is Matt. In today's video, we're going to be closing out May 2025. We're going to be talking about all the trades I executed for May 30th. We're going to be talking about the covered calls, the cash secured puts, and everything in between when it comes to running safe and consistent covered call and cash secured put options. That being said, guys, the purpose of this YouTube channel and this account is income generation. There are plenty of other channels out there that are going to tell you how to do Roth IRA investing or dividend growth investing. My only problem with that is I don't want to wait 30 to 40 years for me to use my money. I want to be able to find and adopt a strategy now so I can start making income today. And then maybe 3, 4, 5 years from now, I'd be able to supplement my daytime W-2 income with the investments I'm running here. If that is something that interests you, don't hesitate to press that subscribe button, leave some comments. I read every single comment. I appreciate all of your likes, and let's get this show started. Any of my returning subscribers, you guys know me. The first thing I like to talk about on my channel is my account value, and more so a sign of transparency than it is bragging. I want to show you guys all of my wins, all of my losses, and the easiest way to do that is looking at the account value, because that does not lie. Currently, the account is at $157,912.60. Let's head over to the spreadsheets and talk about all of the individual trades I have made for May 30th. The high level overview of what happened on May 30th is I ran 2 covered calls against the 200 shares of SPY that I own. I ran 2 cash secured puts against the QQQ with some of the collateral that was available in my Robinhood trading account. My IWM expired worthless today. And then lastly, Robinhood was kind enough to pay me some cash for me holding some cash in the brokerage account. So let's break down each of these trades. The first thing I did for May 30th is I ran 2 covered calls against the SPY shares I own. I own 200 shares of SPY. So the way that running a covered call works is you have to own 100 shares of an underlying. 100 shares is one options contract. And so because I own 200 shares of SPY, I'm able to run 2 covered calls against the shares that I own. When I bought these shares a couple of days and a couple of weeks ago, I bought them at the $593.13 range. So ideally for me to not lose money when I run my covered calls is I have to choose a strike price that is higher than my buy-in cost basis. The way that SPY works is it goes by dollar increments. So since I bought this at like the $593.13, I'm just going to choose the $594 strike price. And that's what I did. And I'm going to explain why I chose this specific strike price and not something higher. But ideally, between each covered call, I made $14 per call. So it wasn't really a lot of money because the SPY was down today from when I bought in at. So let's describe the actual strike price. So I chose the $594 strike price, as you guys can see highlighted. And the reason why I did that is the SPY was trading at the 588. Because at the money, the 588 was significantly further away than my strike price, the premiums are going to be a lot lower. But ideally, in my circumstance, I own the SPY shares outright on 0 margin. So for me, holding the SPY for a couple extra days, taking bad premium, and then waiting for the market to go back up is a better bet than me choosing a strike price that's a little bit lower, closer to at the money, but then with the risk of potentially me selling or getting my shares assigned at a loss, if that makes sense. But the SPY opened at the 588.15, so it closed at the 589.39. And in hindsight, I probably could have chose maybe a strike price of like 592 to get a better premium. However, I didn't want to risk it. I'm winning right now. I'm already up close to like $900 by the time I even ran these options. So for me, I didn't really need to push the envelope and try to risk making a mistake on a Friday. So I did that for 2 of my covered calls. Let's talk about the cash secured put. So the way cash secured put works is investors are going to pay you an upfront premium so that they would offload their shares if the market heads in a downward direction. And so for the QQQ, I chose a strike price of the 515 when the market or the QQQ was trading at the 519.43. So I chose a strike price. I was at $4 away. And the way I choose my strike prices, I usually look at $5 away from at the money. And then I start choosing from there. So I saw the 519.43, looked at the 515, and then started making some determinations. Hey, do I like that premium? Do I not like that premium? So I actually spread out 2 of my cash secured puts. I chose a strike price at the 515, and then I chose another strike price at the 513, right? And so I wanted to do this to spread out my risk because I could have made, 87 times 2 of premium. But like I said, I wasn't really in a rush to push anything on a Friday. I didn't want to get assigned to QQQ over the weekend. So it was more so I was already up. I didn't need to push anything. I still made my money. And my 515 strike price netted me $87, and the 513 strike price netted me $56. For my IWM, I ran this option back on Tuesday, May 27th, and I chose a 209 strike price. Because I bought my IWM at 208.51, I do not want to choose a strike price lower than 208. And because of that, the premiums are going to suffer a little bit. When I initially ran this, I ran it as like a week-long call, and I made about $57. So not too bad, but I'm definitely trying to get rid of my IWM. So the second it hits that 209, I hope it gets assigned, because I just want to free up about that $20,000 so that I can use it towards buying, QQQ shares or maybe some nvdy options. Just food for thought. Lastly, Robinhood paid me about $64 of cash because I use about $110,000 of collateral, which basically is like margin, to run my cash secured puts. But outside of my 100 shares of IWM and 200 shares of SPY, I have about $11,000 to $12,000 of cash. So holding about $11,000 to $12,000 of cash, I made about $64. So I'll take any type of money I can get. All right, now that we talked about the tactical level of what I did for May 30th, let's take a holistic approach of the last 34 trading days and make a determination. Hey, is this actually a viable option for you guys to use in your trading strategy? Let's take a look. Now that we are at my favorite screen here, the overview screen, let's dive into the numbers. For when this project started, I transferred investing from high income ETFs to just running my own options back on April 11th, sold out all of my high income ETFs. I had some of it on margin. I took a little bit of a loss, so therefore I'm not necessarily too worried about taxes this year. But the account value started at $86,312.66. Earlier this month, I also sold a property I was living in, and then I'm in a different one now. But I had about $60,000 of cash that I made from that selling of that property. So I threw it into Robinhood, and the actual number was just like what my account was plus that 60,000. We're going to base all of our numbers off of $146,312.66. But before I did that injection of money from April 11th, where the account was at that 86,000, all the way up until May 20th, I got the account to about $97,359, and that was a 12.79% increase. But then once I did my 60K cash injection into the account, that 60K sum of money diluted the gain. So if we're comparing it to now this 146,000, I'm only up 7.93%. But in the last 34 trading days, I'm up $10,362.63. So that is quite a bit of money. That is no NAV erosion. If I wanted to, I can take this cash out and then do whatever I want with it, and then my account would still be up. Let's talk about my trade win percentage. I'm up 97.06% of my trades. I've won 33 trading days, and I've only lost one. And the average premium I'm making per day is about $304.78. And then for my average weekly premium, I'm making somewhere between $1,480.38. Lastly, the average monthly premium is about $5,181.32. So in the yellow here, I came up with some estimates from the performance of my portfolio over these last 34 trading days. I will say this, take all of this with a grain of salt, because from April until now, the market has been on a bull rush recovering from that trade tariff talks. And then now I think it's going to be more in like a chop. They're going to figure out what the next move is. So I don't know if there's going to be a more of a breakout, or they might get some regression come July if there's no more new trade deals. That's not a political opinion, just me trying to position myself to make the best opportunity in the market. With that being said, I came up with an average yearly premium of $76,979.54. The way I came up with this number is I just took the amount of average weekly premium and multiplied it by 52. So if we do from next week until 52 weeks later, I would make about $76,000. And if we look at that as a percentage, it's about 53%. That might be a little bit optimistic, even if it's 10% less or 20% less, to still make 33% in a year. That's still a lot of money, guys, and I think that would be a success. But I like to live in reality. My initial goal, once I swapped over from high income ETFs into my own options, I started off with a goal of $29,740. And currently, because we're at $10,362, we only have 19,000 more to go, and we are well on our way to meeting that goal. Theoretically, from now until the end of the year, I think there's either 30 or 31 weeks left. If I just come up with the average weekly premium, I'll make an additional 44,000 on top of the 10,000 I've already made. So theoretically, for 2025, I could realize about $54,000 in gains. So that's actually quite exciting to look forward to. However, ideally, I would like about $1,000 a week. Making 1,400 is great, but I think a good consistent goal of not going like too crazy with like margin or any of that stuff, $200 a day to about $1,000 a week. It's like a good touch point with where my account's currently at. Cool. That being said, let's head over to the week over week tracker. Over the last 3 weeks, I've hit the 4-digit club. So I love seeing 4 digits in a row. Bingo, bingo, bango. And to finish off this May month, we made $1,216.10 of premium. And then for the monthly tracker, we crossed the $8,000 mark in this last day. So that was quite exciting. The first month in April, I was trying to figure out still how to like run the options more effectively. Did I want to do $3 different from the at the money, $5, $10? Do I want premium? Do I want to capture appreciation? So I was trying to figure out that right balance. So April was a lower month. It was only $2,289.53. And I started about halfway into the month. So that's why the April numbers look a little low, but May did not disappoint. I'm very happy with how May performed. And if I can make that every single month, I would be a very happy man. And for the yearly tracker, we haven't gone there yet. We are still a long ways away from 2025 to being over, but we are at $10,362.63. With that being said, guys, I think this has been a great success so far. I am taking some of this success with a grain of salt because I happen to, I wouldn't say I timed the market. I just happened to get lucky that when I sold out of my high income ETFs and started running my own options, we had an upward momentum. But even if we take, a 20% premium like calculation to kind of offset that different volatility because it was a little higher because of the market was a little crazy, I still think we'd be up. Take 20% off of 8,000 or 25%. I'd still make $6,000 in a month. That's still a lot of money, and I would still better than high income ETFs. With that being said, guys, let's head over to Robinhood. I'm going to be talking about what I plan on doing for my 200 shares of SPY. We're going to talk about the different covered calls I plan on running, considerations, how I'm going to be choosing specific strike prices. And some of you guys have been asking, I run my options first thing in the morning. Like the second the market opens up, depending on how the pre-market looks, I'll either buy or just run all of my options first thing in the morning. Like if the market's super green, I'll run my covered calls immediately so I can lock in that premium as fast as possible. The markets are red. I'll try to hit some of these cash secured puts on like QQQ immediately so I can maximize that premium. If the day it starts and the market opens and I'm not seeing anything I like, I'll wait like 15 or 30 minutes after the bell rings to kind of see how the market, trends. Is it going up? Is it going down? And then roughly at like the 30-minute mark, I'll probably have some sort of options in play and then just wait for them to either expire or get assigned at the end of the trading day. Cool. Over to Robinhood we go. All right, now that we are back at Robinhood, let's head over to SPY and talk about the covered calls I plan on running for Monday. Let's go head over to Trade SPY options. If you guys see this button over here, buy call, don't ever press on that button. 90 to 95% of investors that press on that button are going to lose money over the long term. So just don't do it. You might have a couple wins here and there and get excited, but ideally, if you're not careful, you can lose a lot more doing buying options than just owning the shares and then selling your contracts to make some premium. You run a covered call in Robinhood, you press on sell call. Let's take a look at this 588.40 and let's just take away everything that is going on with my account. Let's just say we bought the shares at this 588.40 and let's just say we got 200 shares of SPY. So we have 2 options contracts. So let's choose a strike price. So ideally, whenever I start looking at options and their strike prices, I choose something about $5 away from at the money. So this is going to be at the 593. So the premium would be about $92 for one covered call options contract. So let's talk about it. Let's look at the delta. Delta is about 27. So I usually use like actual strike price numbers like $5 away or $3 away, but some people like to use deltas. And what I've noticed, I usually choose deltas between like 20 and 30. That's kind of like a good point of appreciation to like premium ratio. That's what I like to go with. Okay, so now let's talk about a couple of different scenarios. So these works for a covered call is an investor is going to pay you $90 of upfront premium to lock in buying your shares that you own at the 593. And two things can happen here. The first thing, nothing really happens. Investor pays you that upfront premium of $92. The SPY never gets anywhere near 593. You keep your shares and then you can rinse and repeat this the next day. If you're running dailies, if you run weeklies, then you pretty much have to wait until your contract expires. The second scenario, say for example that the SPY blows way past the 593 and shoots up to like the 598. So let's talk about what happens here. So theoretically, you're going to make appreciation from this 588.40 all the way up until this 593. So you make about $500 of appreciation that you're going to realize. Boom. And before anything happened, you got paid $92 of upfront premium. So you almost made like a $600 move in one trade. However, the one downside with this strategy is not necessarily a risk, but you lose the opportunity for more money, but it's not like guaranteed. So theoretically from 593 to 598, that's like lost potential gain. So it would have been like you would have lost about $500, but you didn't realize anything. That's just like money that you could have made that you didn't make. You didn't lose anything. You just didn't realize that. But you did lock in that $500 of appreciation plus that premium. And the other downside with running a covered call is kind of the scenario I'm in with my shares at like the 593 and me having to choose strike prices that are higher and further away from at the money. So say that we did buy shares at the 588.40 and the market tanks to like the 578. So what happens here is because like my philosophy is I don't like to choose strike prices below my cost basis. So I would still be choosing strike prices at this like 588, even though the market would be trading at this 578. My premium that I'm going to be generating is going to be significantly lower because I don't want to risk getting an assignment where I realize a loss. So let me explain that. So say, for example, we're trading at this 578. I bought in at this 588 price. And because I'm greedy and I want some premium, I'll probably choose a strike price of the 582. So if the SPY then jumps the next trading day from 578 to 582 and you have to sell the shares that you own, you theoretically lost from 582 all the way back up to this 588 mark. So you almost lost like $600 of appreciation. You realize that loss because you chose to choose a strike price closer to at the money. However, there are ways that you can avoid that assignment. You can buy back the option where you use your own money to then purchase back that option, or you can roll it further away so you don't have to like use your own money. You can just push out the option a little further away so that it can be in your favor. However, for me, I will usually wait like a couple of days, couple of weeks before I start getting a little feisty like that, when I kind of get greedy and I want some more money. But ideally, I would just wait until the market recovers. It's going to recover in a week or two, unless there's some huge regression. So those are some of the thoughts when it comes to the options. So if you happen to buy in at this 588.40, I'd probably choose a strike price of 593. But because of where I'm at in my circumstance, I'm probably going to run this 594. And I'm probably going to run both my covered call options contracts at this 594. So I'd make 66 times 2. So that's like $126 or $132. Yeah. But now let's head over to QQQ and talk about the cash secured puts. But before I do that, I want to show you guys the buying power. So this is how I can own shares of the SPY. So I've bought $118,000 worth of SPY shares. And then, but my other buying power, I have $121,000 of event contracts. So that means I can use that to run my cash secured puts, and that's the collateral I was talking about. Because usually the QQQ fits, I can buy about 200 share, or I can theoretically use collateral for 200 shares of QQQ. This fits in perfectly with my investing strategy. So ideally right now, for my SPY shares and IWM, I am not on margin. However, if my cash secured puts get assigned, I will be using a little bit of margin during the assignment, but once they get assigned, I plan on selling at the money to then offload that margin, make a lot of premium, and then rinse and repeat so I can start running the cash secured puts again. So that's kind of the strategy. Let me go to QQQ and actually like visualize and show you guys. Okay, now that we're at QQQ, it's trading at this 518.49. Let's go to trade QQQ options. Make sure that we have the correct setup. To run a cash secured put, you have to do sell put. And market at this 518.49. So let me explain a cash secured put. Let's choose a strike price. Usually I like to do $5 away initially. So what is that going to put as 513? I would do the if on Monday the 513 strike price for a cash secured put for QQQ is available at this $76. I'll probably just run 2, make it nice and easy. So I'd make like $150 from this cash secured puts running 2 of them, and then the $132 of covered call income. And yeah, that would be like a $200+ day. It'd be solid. Let's play devil's advocate. Let's say we actually run this cash secured put. So the way the cash secured put works is investors are going to pay you an upfront premium. So theoretically here, they're going to pay you about $76 per cash secured put contract. Only thing that you need to bring as an investor is collateral. And to run this cash secured put on QQQ, and for a normal investor that doesn't have this kind of level of collateral, you can run it on like Amazon shares or Nvidia shares. So just whatever I'm saying, just apply it towards the like a stock that you can actually afford and do this on. But yep, investor is going to pay you an upfront premium of this $76. You just need to bring collateral, and for that collateral of this QQQ, you need about $51,300. And so if I'm running two of those cash secured put options, I would need about $102,600 of options collateral, which you guys saw on my account. I did have that. So therefore I'd be able to run this and make that premium. So let's start running through the scenarios. First one, nothing really happens. Investor pays you that $76 of upfront premium. In the case that the market heads in the opposite direction and they want to offload their shares, we choose the 513. Market doesn't go anywhere near the 513. It stays at 515, stays at 518, whatever. So you get to keep that upfront premium. And at the end of the trading day, you get your collateral back, and then you can run this again the next day. No problems. Scenario number 2 is that investor is going to pay you that upfront premium, but then the market goes down up to this 513 or below. So therefore, you are now going to get assigned the 100 shares of QQQ. So a covered call, the difference between a covered call and a cash secured put, a covered call, you own the 100 shares and you are selling your shares to somebody else, versus the cash secured put, someone is paying you to buy their shares from them. So that's the difference. And the way this works is once that assignment happens, you buy the investor's shares that you agreed upon at this 513 mark. And usually, personally for me, whenever I get cash secured put assignments, I will sell at the money. So if the market went down to 513, I'm going to sell at the money so I can rack in a good premium, and then I can offload the shares because I don't want to hold the QQQ shares on margin. Let's talk about the negative effects. So say we still have this 513 strike price, but then the market goes a little bit further down, right? Say it goes down to like 503. So theoretically, if the market were to go down that far, you'd be down about $1,000 of depreciation. And the only way you actually lose the money is if you sell at this mark at a loss. But if you're just patient and just wait for the market to go back up, then you're going to be fine at this 513. However, if you wait some time and you're like, man, I kind of want to start making premium, therefore, then you might start getting a little bit risky and then choosing strike prices a little closer to at the money, but then you're risking assignment and then actually realizing a loss. So that's kind of like the negative side of the things. But with that being said, guys, that pretty much wraps up the video. I talked about my covered calls, my cash secured puts, what I plan on doing for Monday. If everything stays exactly the same, I'm probably going to choose that 594 strike price for SPY. And then for QQQ, if this 513 is around with this kind of level of premium, let's take a look at the delta real quick. Yeah, as you guys can see, like just naturally by me going like $5 away from at the money, it's like a 10 to 20 delta, 10 to 20 to 30 delta. So that's kind of the range I like to trade in. That wraps the video, guys. Hope you enjoyed it. Hope you learned something new, and hopefully this is something that you can adopt into your investing strategy. You don't need to have an account that's like mine, like $150,000. If you have a $10,000 account or a $20,000 account, you just need to find a stock that kind of fits that threshold, and then you could run options against it so that you can make an additional bit of income while investing into good investments. For QQQ, I can hold on to QQQ for the next 10 years. I know it's going to make money. Same thing with SPY. I can hold on to it for the next 10 years. I know it's going to go up. So therefore, I highly recommend when you guys do your option strategy, don't choose stock because the premium is good. Choose stock that you're actually wanting to invest in and you wouldn't mind holding long term. And the other philosophy I have that I really have like two rules: invest in actual good investments. And then the other rule is don't choose strike prices below your cost basis. You follow those two rules, you are not going to lose money running options, period. Yeah, guys, that wraps the video. Matt out, and I'll see you at the next one.